We've seen the AI boom, but what about the bust? Some are calling this the time where we repeat the bubble of 2000. Others are saying no, it will go on forever. I'm going to show you what we can absolutely guarantee at this time. At the same time, we need to be looking at where we should be putting our money and how we should invest, all of that and more. Let's begin by taking a look at the number one risk for tech stocks. You can see it right here. EU brings down the hammer on big tech as tough rules kick in. The world's major tech titans must crack down on illegal content to keep European users safe online on Friday. Far-reaching EU rules force digital firms to fall into line. You've had Canada that restricted forms of news on Facebook platforms. And it's important to note that this is one after the other of an increase in regulation on the tech industry, which is basically largely unregulated. They operate as an arm of the government, and so they're able to do certain things, get as much data as they need, and data is money these days. So I believe that regulation is really the number one factor determining the prices that you'll see in the stock market for these type of stocks. You don't look at inflation, of course. Interest rates are high. When they go higher for longer, we can see that the stock market doesn't necessarily behave the way that most people would. They don't want the interest rates at these levels, especially tech stocks don't like that. Right now, we're seeing so much foreign investment. Foreign investment into US equities has been going wild. And so as a result of that, we can see times get wacky, and that's kind of where we are at today. All right, then we also have bubble valuations. As you look at it from, it's not just Nvidia, but we use that example today. A lot of these different companies have gone into no man's land. At the same time, stimulus from other countries really makes them more attractive. So if China is going to continue to stimulate, that would pull money their way. It could be the same for Europe. It could be Canada, wherever. But right now, the world is pumping their cash into the United States. That is very clear, overwhelmingly. Regulation at the same time is really one of the big concerns that we have, as I explained a moment ago. So we'll keep an eye on that to be able to determine, hey, if they're going to start regulating tech, they're going to regulate AI, that slows down the growth potentially. You may argue that's a good thing, but in terms of the stock prices, not necessarily, at least in the short term. All right. September tends to be a bad month when you look at it overall. For the stock market, nobody knows what happens, but it's just generally not a strong month. Some are going even further to suggest that there will be a credit event in September. So keep your eyes peeled. I can tell you though, the market, most investors, their bet is that volatility will decline. And when volatility declines, that essentially means that, they're going to bet that the markets will go higher and everything is also Goldilocks and the three bears. At this time, they've been right. This is Michael Gayed, and I did an interview with him a little while back. He has some interesting things to say. Breaking: Nvidia can take down the entire stock market. Now, not so sure about the entire market, but I can take you into this chart here and you'll see it. Top 5 stocks account for 60% of NASDAQ gains. And so we do have just a few stocks carrying a lot of the gains that we've been experiencing. And you look at Nvidia, I mean, it's on the top of the list in terms of the percentage gain. Look at that. It's showing 18%, it looks like. And of course, that is something that it's worrisome, actually. People will say, that's fantastic. Look how well it's done. It has to be balanced, right, to some degree. And we're definitely not seeing any balance today, that's for sure. Technology stocks are hugely overvalued based on some metrics. This is just showing you the current level and fair value, as well as the implied upside downside. I'm not so sure you can factor this in any way. You could do ratios, but is that necessarily going to be something that, we have to pay attention to in this way and not necessarily. Anyway, this is just showing us that the markets are suggesting it could be overvalued based on some metrics. The market determines that based on how many people are willing to invest in it. That's a simple matter of fact. When the investors run out, when enough people on the buy side run out, then it starts to go in the other direction. It's a simple matter of fact. I just thought it was interesting, of course, to look at PE ratios. While I don't necessarily invest based on PE ratios, it's a basic indicator that we should pay attention to look at valuations. And very clearly, when you look at the S&P 500, their PE ratio at 18, basically 19, compare that to the tech stocks and you look at it at over 25, historically out of whack. It's supposed to be somewhere around 16 or 17. So we're already above that with the whole, like, think about where we are today, near all-time high. And we are basically being pulled by these few stocks that are, their PE ratios are off the charts. Interestingly, this is JP Morgan's top tech trader, Ron Aller, who basically, he made a few comments. I wanted to touch on them. The AI hype continues to wane. Companies spend too much time on AI on their earnings calls and analyst days. Now it starts to putting up the results. The experience of these products has underwhelmed users and the novelty could wear off quickly. Yes, there's a cool factor and real world use cases, but aside from executives in leather jackets, it's unclear how most will monetize and implement. And so that's what he's saying here. I think it's, we can agree to that. A lot of people say, AI is a lot of hype and maybe there is some cool stuff coming, but we're not there yet. You can't pull too much from the future into the present. And we'll talk about that more in a second. So right here, what I wanted to show you was a few things that you need to be doing as an individual. Number one, for most people, investing long-term in a broad index will be the best method. And that's because you get diversification, yes, but less maintenance. And people, the average person, they can't be there. They can't be, looking at the markets every single day. It's not something that the average person could do. Buy into companies that aren't hyped. That's important as well, because the hype is clearly something that, it generates the excitement behind the company, but where are the fundamentals with that company? Valuations shouldn't be based on something unproven as well. Oh, in 5 years, we're going to have this great thing and it's going to be fantastic. Just believe us. There are a lot of companies like that. You need to see the actual proven, at least prototype or something that gets you, okay, I get it. It's just a matter of getting this into people's hands, the customers' hands. If it's just, hey, this is what we're intending on doing, and billions and in fact trillions of dollars being thrown into them, can't really agree with that. Watch companies' exposure to other countries. This is another one that's often overlooked. If you are, any company, whether it's Xerox or maybe you're looking at IBM or Apple. If Apple is selling phones to the US market, that's great if the US customer's buying it. But if that Apple is basically selling to China and China is in a recession, they're not going to buy as many phones. That means the total sales of this company are declining. And as a result, you have a problem with that company. Just because it's headquarters, it's actually at, it's a U.S. company and so on. That doesn't necessarily mean that you should only look at the U.S. Very important stuff. Okay. If you want to know more about the stock market, if you want to know about the economy, if you want real estate tips, if you want to connect with me directly, Discord is the place to be. Over 1,300 people. Click that link in the description and join the chat. I'm in there every single day, so you could join me any day. And this is the comment of the day. Edward, as time goes on, less and less people will be able to purchase a home. This is by design. Recall, the WEF said that we'll own nothing and be happy. That being said, if you can make the numbers work, this is a great opportunity for a buy buy and hold real estate investing because demand for rentals will continue to increase. Certainly right now we are seeing that demand is very high and the prices are also very high, okay? And when we look at it for multifamily residents and things, these become very attractive as an investor. It's not bulletproof, of course, but that's the kind of thing that will probably look good for the while, as long as we are in this environment of, this is a tough circumstance, right? So more and more people are going to need to rent. They can't afford to buy. And quite frankly, this real estate market with not enough incentive to build right now, it's just going to get tighter and tighter and tighter. All right. Hope you appreciate this video. If you did, hit that thumbs up button. It's right down there beside the subscribe. And as always, I'm bringing you videos all the time, so you definitely want to check me out. I'll see you on the next one. Take care.